So everybody, this is Kyle. I'm just going to do a quick intro, and then you can kind of add to that intro too if you want, Kyle. But this is Kyle Wilson. He's with CBRE. This is our Excel sheet that we have him. We actually have him sitting right now, right there. Right now, I think we're over here in the large balance commercial perm requests. So if you go to your large balance commercial perm requests, you'll see him in that lender bucket. So we brought Kyle on because we were kind of suffering on the large balance perm stuff. We got a lot of small balance guys that do perm, but not a lot of large balance. And Kyle is kind of agile in a way. They can do a lot of other things that most of our other lenders can't do, and us smaller brokerages cannot do. So, for example, they have correspondent relationships, for example, with life insurance companies, which requires quite the big track record yourself if you want to start getting that kind of money. So we're going to let Kyle kind of dive in further on his primary product, the one that you guys sell primarily. And then later on, Kyle, if you don't mind kind of divulging in the other options when you decide to correspond and what have you, or broker. And just so you know, primarily when we send deals to you, we want to get reviewed on your primary program that you're not brokering, just to keep costs low. And if you ever decide to do something else, we just want to know at the end of the day. So I'm going to stop sharing my screen. So just so you guys know, this is where we're at with Kyle. Kyle filled this out. And if you want to kind of fill me in, Kyle, on anything that we might have missed in this, feel free to let me know. And I'm going to let you share your screen now if you have do you have anything to present or you want to share?
I mean, I have a very high level, just team overview of myself and my team, but I mean, happy to share it if you want. I can send it to you guys to send it to the platform as well after, whatever you think is best.
Sure, let's do that. So you can share your screen. Go for it, brother.
Yeah, so I appreciate that, John. So high level, so let me just do this real quick. So I'm on what we call CBREs. Can you guys see that?
Yep.
Yeah, so CBRE, Southern California, what we call private client lending. Really what private client means is anything in the $1 to $30 million space. That's really my area of expertise. We can go bigger, can go smaller, but sweet spot's really $1 to $30 million as far as loan size. When I say SoCal, I'm not bound to Southern California by any means. I just sit in San Diego, and I have a partner and 2 analysts on my team that sit out of our Newport office. So why it's called SoCal is just because we physically sit here, but we do lend across the country. As far as, oops, sorry, it's a little jumpy. As far as just deal scope, deal size, as mentioned, that $1 to $30 million space is really where we cut our teeth. And what we would try to base it off of is just these core values. Execution and expertise are really our main things. When it comes to execution, we underwrite the deal fully up front. I have my 2 analysts, Jack and Brianna, who are studs in the space. They will fill out as much as possible for the borrower. They will make it easy on you. We handle every transaction. We're all in on it together. So just to remove any room for error, right? We don't want to have a deal get signed up at a certain loan amount, and then in underwriting, it gets kicked back at a lower loan amount. That's not productive for anybody. So our main product, to John's point, is our in-house product, which I think is where it would be a little more accretive for you guys just because fees are lower. But the in-house right here is, as you can see in this bucket, it's our Freddie Mac and Fannie Mae. What that is loan amounts from $1 million to 7.5 is a small balance. We can do larger deals than that. That would just be more of a conventional product, but it's a government-backed agency that we are a seller servicer. So we write those loans, we service those loans. It is our in-house capital. It's a 5, 7, or 10-year term, essentially 30-year amortization on all of them. We can certainly do, this just touches on the volume we did last year, but it talks, that product can offer interest-only options as well. And it's non-recourse, which is a big thing for a lot of investors, especially in this world. Meaning there's no personal guarantees on the loans. They're not asked to sign a personal guarantee. With that, we don't need tax returns. It makes for a smoother, simpler process, and then it removes the risk on their end. Rates right now on that product are low to mid 6s. We may be able to get sub 6% for the right deal, and those are typically underwritten to a 1.25 DSCR or debt service coverage. That's how we derive what loan to value is available. We can get up to 80% loan to value on a best case scenario. Most deals probably end up closing around 70-75% loan to value. So that's our in-house product. That's our agency lending here. And then this just touches on different products we have, but essentially it's how you can treat us for those loan programs is as a direct lender. So it's really pretty simple. It's any sort of stabilized multifamily. So we need at least 90% occupancy over 90 days. It needs to be at least 5 units and $1 million loan amount. If we can check those boxes, it'll fit in there. And CBRE over the last, I want to say 7 years now running, has been named the #1 seller servicer of these products. What that really means is we do more loans in that space than anybody across the country on both a volume and a loan amount. So we do have a pretty well-oiled machine internally to get them done efficiently, that we just have to by doing the volume that we do. And then the way we help with certainty of execution is we are internally underwriting it hand in hand with Freddie Mac, who is essentially the lender, but we're underwriting it on their behalf. So we have a lot more control over the deal. With that, we're having a typically CBRE appraiser, CBRE lender legal, CBRE underwriting team internally. So it just removes a lot of room for error from a communication standpoint and allows for an efficient transaction. But the main, again, touching back on main terms as to why this product is something that most people would be excited about, is the non-recourse, interest only, low rate, and we can get pretty good leverage on it as well. We can structure it around the borrower's request for as far as term length versus quote, prepay penalty, so on and so forth. So what I would just need to get internal quotes put together is just a basic rent roll, profit and loss statement, and if it's a acquisition, just what the purchase price is. From there, I can put together quotes in a matter of a day, turn around a number of options for you guys. I try to present what we call internally a menu of options. Really what that is 3, 5, 7 quotes, whatever we can do to present a breadth of options to the borrower and really build out the quotes around their goals, right? So that's a pretty quick high and low on our internal bucket. This page talks about it more, what we call agency lending. I'm not sure if you guys are familiar with them, but they are government-backed agencies, Freddie Mac and Fannie Mae, but they have a mandate to lend on affordable housing. So multifamily, that's basically just market rate multifamily. And you can't just get one of these loans from anyone. You can't just call Freddie Mac and say, hey, I want a Freddie Mac loan. You have to go through a seller servicer. I believe there's only 7 of them across the country. And again, CBRE has been the #1 for quite a few years running now. So that's our internal debt platform. We can, again, build it out how you see fit. And typically going back to terms where it wins again is non-recourse and interest only and low rate. So it does lend nationally. We have different ways to knock down the rate. Sorry, we're still here. Whether there's affordable units in place, we get rate discounts. If you're below a certain loan to value, we get rate discounts. So there's a few ways we can really structure this to help match your borrower's goals. But that's a very, very high level on Freddie Mac and Fannie Mae, which again is our internal platform. So I'm happy to open it up, answer any questions there before really moving into the other half of the business.
Sure. How do you underwrite borrowers when they're buying an asset? Are you looking at FICO? Are you looking at experience? What's the story on your borrower underwrite?
Yeah, good question. So being that they're non-recourse loans, the heavy majority of the underwriting is property focused. So as far as the borrower is concerned, we look at net worth. We want to make sure the net worth is equal to or greater than the loan amount. So $2 million loan, we want at least a $2 million net worth, right? For liquidity, we want to see at least 9 months worth of loan payments in liquidity. That could be in cash on hand. That could be stocks. That could be retirement accounts. And then credit score, we want to see at least a 650 credit score. That's about it. We just want to check those boxes. And then the rest of it is going to be all driven towards the actual cash flow of the asset itself. So it's a pretty simple requirement, or at least box checker on the borrower side. The only other thing is experience, to your point. It is a lot easier if they've done a multifamily deal in the past, and multifamily is defined as 5+ units. If they haven't, but they've done a few smaller deals, we can work around it. We can get an exception granted, but that is more on an exception basis.
Got it. Can you explain to me your relationship when the deals are coming from private money loan brokers like ourselves?
Yeah, so ideally we would be able to speak directly to the borrower, and the reason being is just that it makes a much smoother transaction, being able to hear directly what it is that they're looking for, answering any questions, talking through the process. So I would, ultimately I defer to you guys because it is your client. I want to respect that client relationship. I'm not trying to step on any toes. So I would always ask that, if you wanted to run communication between you and your client, happy to do so. But I think it's simpler, again, just from an efficiency and time standpoint, to speak directly with them. I would prefer that you guys stay copied on emails, be on every call, stay involved as much as you want. If you just want to hand it off and say, tell me when it's closed, I'm happy to work that way as well. But working in this case as a direct lender, we do have some flexibility there. With Freddie Mac, they do have pretty strict requirements post getting the loan signed up. So once the application is signed, they do want all of the documents to come directly from the borrower to us. They can't have it go through a third-party source. The reason being is just to avoid any sort of fraud or anything like that. But up until that point, we can manage it however you see fit. Again, I would, even if documents are coming directly from the borrower, I would still encourage to keep you guys involved, include in, just so you see what's happening in the transaction. You can see the process firsthand. And then as far as payment, we can get you guys paid one of two ways. If you want to have your own fee agreement with the borrower, we can have our own fee agreement. On the closing statement, there's two fee agreements, one for you guys, one for us. If you think your borrower, because you guys know your clients best, if you think they'll balk at seeing two fee agreements, what we can do on the other end then is just increase ours to accommodate yours as well. And then you'll just see a CBRE fee on the closing statement, and post-closing, we'll just turn around and pay you guys your fee as well. So it'll be the same amount for you. It's just a matter of whatever you think your client would respond best to.
How much do you guys normally charge? And just kind of high level overview, depending on, maybe you give us an example, $7 million purchase, multifamily, perm loan. How much are you guys charging on that, and how much are you going to allow us to come in?
Yeah. I mean, you're allowed to charge whatever you want. We're not going to put guardrails up. As far as our fee, typically the larger the deal, the more room we have to pull it down, just because we have the same overhead and same cost for a $10 million loan as a $1 million loan, right? So if it's anything over $3 million, we would just ask for a 1% fee. If it's in that $1 to $3 million space, we may ask for a 1.5, 1.25, something like that. Also want to be cognizant that if we ask for a 1.5 and you guys already get a 1.5, that's a lot to the borrower. That's a 3% fee. They may push back on that. So as far as for the sake of building out a relationship with you guys, we would be happy to accommodate and pull that down, especially with this product being that it's internal. Our costs are a little bit lower than when we work as a broker, which we'll get into next. So I would say our minimum fee would try to be at 1%. But as the loan gets a little bit larger, we do have some room to pull down as needed, if needed. As far as your fees, that's entirely up to you and what you think you can, first off, what's it worth to you as far as time spent, and then what also you think the client would be comfortable paying. So that's up to you as far as what you guys want to charge.
Got it. Now let's talk about like property asset types. So what asset types are you covering on this program? Do you do assisted living? This is kind of a unique request we get a lot of. Just multifamily? Do you do any kind of, retail? Like, can you kind of zone in for us what you're looking for on asset type?
Yeah. So as a whole, we can accommodate any asset type. For this specific product, for Freddie Mac and Fannie Mae, it is strictly stabilized multifamily. So 5+ units, multifamily, 90% occupancy. With that, we can do assisted living, to your point. We can't, the carve out there is we can't do assisted living with services. So if there's nursing services or things like that associated with the business, it becomes more of a business loan than an actual investment loan. So that's where it gets carved out. But with that, we can do, if you have couple of properties all adjacent to each other that are maybe individual homes or duplexes. We can tie those together to consider that a multifamily property. So we can do that. We can do student housing. It can do military housing up to a certain percentage. It's once for students in military, as long as it's under 50% on both of those and 50% market rate, we can do. Product is great for affordable units, any Section 8, any sort of affordable rents. We actually get discounts in rates. So having affordability in there does allow for rate discounts, which allows us to get a little more aggressive on loan proceeds as well. So for this product, think of it as just strictly multifamily, $1 million or over 5+ units. And then anything outside of that, we still can do, but it would be more through our brokered platform as opposed to our direct capital.
Gotcha. All righty. Well, that's all I have in terms of questions for this product. Does anybody else have any questions regarding the multifamily agency stuff? Because we're mostly private money over here, Kyle. So rolling in agency products is a little bit more awkward, but we love the lower rates. We can definitely sell a lower rate. Justin, do you have any questions, brother?
I mean, I've got one that came in today, actually. It's a $5.7 million building in San Diego. They owe like 2.3. So they want to do a cash out refi. But they're going to run the objective is to run a cannabis business out of it. Is that something that you guys can do?
It is. There's a few lenders I work with. It would be more through a bank, so we would have to broker it to that bank or banks, multiple of them. Because the cannabis component, typically cannabis is not legal federally, right? So it's hard to find a lot of lenders because most banks are chartered federally. So it's more those local or regional banks that can do it, that are more bound to just California in this instance. So there are some. I've done cannabis deals here in San Diego. I do have outlets for it. They're just gonna be a little more expensive, honestly, just because supply and demand, less lenders willing to do it.
Sure.
So less lenders, the ones that do can charge more. So for a deal like that, I think the rate would be probably closer to 7.5 or 8%. But it is doable, to answer your question.
Okay. I will send it to you when we get off the call.
Okay. Yeah, and happy to look through it and talk through it offline as well, and if any questions come up.
Okay,
Yep.
cool.
And Justin, just remember to get your fee agreement on that, because it sounds like Kyle's not going to go the regular agency route. So, this is going to be brokered to a regional bank. So you're sitting on 2 fee agreements essentially. So just iron that out, man. I don't like co-brokering. That's why I was telling Kyle, hey man, let's avoid the co-brokering as much as we can. That's against my policy in the program. So, but just make sure it's crystal clear, brother, before you go too far. And you already understand that.
Yeah. Okay.
Yeah. To John's point, I do a fair bit of co-brokering. It gets done. It's clunky. It gets a little more expensive to the borrower. So I'm very much open and happy to do that with you guys. But to John's point, we really need to make sure our ducks are in a row as far as the borrower understands it and fee agreements are in place, and no one gets cut out.
Yep. So you would probably reference Kyle as a lender. Kyle, would you guys actually lend the money on this and then sell the paper to the bank, or what's the story there?
No. Yeah, we would never touch our balance sheet. We would strictly broker it out. So I would call the 5 or 6 banks that I know that could do a cannabis deal. I would get quotes from them based on what they could do on this specific deal, present them to you and the borrower. And once the borrower picks the option, then we would actually engage the bank and get a term sheet from that bank. So it would never be on CBRE's balance sheet. We're strictly just an intermediary between you and the borrower and then the banks that can do that deal.
Got it. And what would you end up charging on something like this, man?
Yeah. So again, just because it's a little more labor intensive and not internal money, we would charge a little more for a deal this size. Say it's a $3 or $4 million loan, you could probably get away with a point as well. Anything less than that, we would have probably 1.5.
And then
if
what
it's a
about
larger deal, again, there's room to come down.
What about your regional bank? What would they charge on something like this?
Yeah, most banks are going to charge anywhere from 0.5 point to a full point. So that's where it just starts to get a little more expensive when it's direct money. You don't have that bank's layer of a fee for in this instance when we're brokering it. You're going to get paid, we're going to get paid, and the bank's going to have their fee. So it just adds another layer, which is again why I'm happy to get a point on that. If you get a point, and if the bank gets a point, we're all of a sudden a 3% fee really quickly. So something to keep in mind when co-brokering.
Yep, you're stacking pretty hard right there, Justin. So, I mean, multiple fee agreements too would probably be an issue. I would probably just make an agreement with Kyle to get paid a percentage if they are going to need direct contact, you know, which you're going to want to just give them direct contact if you're going to go this route.
Yeah. Okay.
So
and again, what we can do to make it easier as well is basically just have the fee agreement baked in. So I would just charge a 2% fee, and then at closing, I would just pay you half of that. So instead of having 2 fee agreements plus the lender fee, we would basically just double ours and pay you out of that, just to make it a little cleaner.
Yep, that's what I would do for sure, Justin. And just be super transparent with the borrower. Just say, you know, you partner with CBRE on loans like this. You know, Kyle's the contact. My issue, Kyle, would be like repeat business for Justin. Like if that borrower comes back to you, that's going to be frustrating for you know, the referring broker, right? So
yeah, I understand that, and that's where it's just up to us to be really transparent with you guys, and I'm happy to sign fee agreements tied to referral agreements, I should say, tied to that specific borrower. So if he does come back for a second and third loan, I would still want to pay you guys. I'm not trying to steal business. I'm trying to provide a solution. So in that instance, I would do my best to keep you tied in for any future business that comes from him. But to your point, John, things can fall through the cracks. You know, 3-4 years go by and you may forget where it comes from or whatnot. So I'm brutally honest. I will do my absolute best to make sure that you guys are always involved. But, you know, there are at times errors in there just with reporting and whatnot.
Yep. I would just play a very hand-holding process. If I were you, Justin, just handhold the whole time, schedule every call, and act as a processor in essence, and allow Kyle to be the authority. But yeah, and then that'll gain trust, and then that show him your ability to pivot as well. Maybe work on an exit strategy with the borrower. Okay, cool. Well, let's talk about, so that's a way that you would broker a deal, you know, and review a scenario. So why don't you tell us a little bit about kind of like the large balance commercial bridge stuff, kind of that's more unique, that we would utilize like an insurance company, but we don't qualify to work with an insurance company. I want to hear a little bit about those kinds of projects that you guys would work on, and what value you provide on that end, and then we'll wrap up.
Yeah. So here's high level slide on our brokered platform. That was actually a good transition, Justin, into it. So as far as all brokered platforms, we have 4 buckets, right? We have life insurance companies, banks, credit unions, and debt funds. The debt funds, which could also be considered private capital, that's what's going to be that bridge product, to your point, John. So depending on the deal, it's going to really dictate which capital sources, we call it, is going to be the best fit for that deal. So if they're looking for long-term debt, low leverage, and absolute best rate available, that's going to be your life insurance company. If you want something with a ton of prepay flexibility, but willing to sign recourse, that'll be your credit union, and then the banks fall somewhere in between those two. And then to answer your question on bridge, that's going to be your debt funds or your private capital. So typically the scenario where you would go more that bridge route, that's going to be your 2 or 3 year term. It's full term interest only, and we're underwriting the loan to cost. So total project cost being your purchase price plus your renovation budget. So it's usually best for, I'm doing a bridge deal right now here in San Diego, and just use that as an example. It's got seven units on it. 3 of the units are occupied, the other 4 are vacant. It needs significant rehab. It is pretty distressed. So that's not going to cash flow well enough to support a permanent loan from a bank or a life insurance company, just because there's no in-place income to support that loan amount. So that's when you would take bridge, because we're underwriting to your year 2 pro forma, or your projected income once the property is stabilized. And then we also can include any rehab budget into the financing. So in this instance, we did 70% of the purchase price as a release as an initial advance and loan proceeds. And then you have a separate bucket for 100% of the rehab budget. So as they're going through the renovations of the property, that money will get released to them as they need it. The reason it's not all advanced up front is just because if you have a couple $1 million renovation budget, you're not going to need all that money right away. So you don't want to pay interest on it until you start needing it. So that comes in disbursements throughout the renovation. And then the idea is once the property is fully stabilized, you would refinance into a life insurance company loan or bank loan or Freddie Mac, like we were talking previously. So those are short-term loans. They do finance properties that are more projection based. So because of that, it is more risk. It's a riskier loan for a lender because you don't have the current in-place cash flow to support the loan. So with that, they are a little more expensive right now. Those loans are pricing in the, call it 9 to 10% range. They are full term interest only, however, so it's not going to kill your cash flow as much as a 9 or 10% rate would imply. But it's just a short-term loan just to get you to a place where the property is stabilized, at which point we fall into those life insurance company, bank, or credit union platforms. And that, again, is just going to come down to loan to value versus interest rate versus prepay flexibility. Really, whatever terms the borrower is seeking or the deal calls for is where we'll pivot and direct us to those different lenders. And again, how I typically like to operate is I'll get a number of quotes in each of those groups put together for each deal. So we have a number of options to choose from, and we can talk through different structures with the borrower and pick the one that really makes the most sense for them. So we do have, for a lot of the life insurance companies specifically, we have correspondent relationships. This goes for banks as well, where we would broker the loan to them, we would help them originate it, and then we actually service that loan for them. So that loan stays on our books from a servicing standpoint. The reason why that is a benefit to you guys and your clients is twofold. It's cheaper to originate because the bank is not paying for a servicing team to do that in-house. But secondly, is we have more control over it throughout the life of the loan. We know when there's an issue we can help the borrower with. We know when the loan is coming due, we can help them pay it off in time before the maturity date. So we're just much more in tune and have a better kind of white glove treatment, if you will, throughout the entire life of that loan. And then beyond that, these banks and life insurance companies that operate off of a correspondent relationship, not everybody has access to them. You have to be a correspondent to get access to those products. So if John was walking down the street buying a property and he wanted to call Aetna Life Insurance Company and get a loan, he cannot get one as an individual borrower. You would have to go through a correspondent firm, which CBRE is, to all the large lenders out there. So it does allow us access to products that would not otherwise be available to your borrowers. So that's a high level, and to that scenario that Justin mentioned with the cannabis deal, this is how we would execute it. It would be through our broker platform. We would call a number of different banks, the credit unions, life companies, debt funds on your behalf, put together matrices, put together quotes, and then move forward with that bank or that lender that does provide the winning option. And this, again, going back to property types, our Freddie Mac, Fannie Mae, again, is strictly stabilized multifamily. This can accommodate any property type, whether it's bridge, construction loans, permanent loans, or what have you. Like the only requirement we have here for this is it's $1 million minimum, but as long as it's anywhere in the U.S. and any asset class, we can accommodate.
Very nice. Yeah, Kyle, I don't see our group probably using you for private capital because that's essentially what that's our niche.
Exactly.
That's what we broker, as well as the portfolio lenders. We have quite a few portfolio lenders in our in our database. Local and regional relationships. If we can't source a local or regional relationship, then yeah, obviously, like Justin says, hey, hook me up, right? So,
Right.
But yeah, that life insurance piece and your agency stuff, this is probably where you're gonna get the most traction with us. So just to give you a heads up on any kind of conversations you're having with people in our group, that's probably where you're gonna want to steer it. The other pieces probably won't be as attractive, but it's good to know you can do all three, man. Can you send this deck to us when you get off the phone?
Yeah, absolutely. I think the rest of it just talks through some deal highlights that we've done in the past. So yeah, I'll happily send this to you. And then feel free to, you guys have my contact information, happy to be a resource however I can and really help out in any way possible, whether it is just talking through just a little information on our individuals of our team. But yeah, happy to help however I can. And whether it's just answering questions or actually working on a live deal, let me know and happy to jump in as you see fit.
Wonderful. Thank you so much, Kyle. I appreciate it. And you'll be CC'd on the email that goes out here in a minute.
Okay. Sounds great. Thank you.
All right. Anybody have any other questions before we call the meeting?
No, John, but can you give me a call right after the meeting?
Yeah, I got
Quick
you, brother.
call.
Yeah, no problem.
Me too.
Uh-oh.
Or
Oh,
just
man.
read
Is
my
everybody
text.
waiting for term sheets? Am I dropping the ball that hard?
Yeah. Get some term sheets done, man.
Oh, snap. All right, guys, no problem. Thank you. Thank you so much, Kyle. Thank you, everybody, for being on the call. God bless you guys, and we'll see you next time.
See ya.
Thanks, everybody.
Bye-bye.